Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites PIFinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Drew, the last time we talked, the markets were in horrible shape, but in the last 4 weeks, things have really picked up. What has happened since then, and what do you think is going to happen now?
Yeah, I mean, since we talked a month ago, I thought we were nearing what could be highs on this market rally that we've seen, or the end of March lows. That obviously hasn't been the case. We did have a pullback, a small pullback since then, but it's since moved to new highs, the NASDAQ moving to all-time highs on this move. And I think it is important when the market had sort of stalled out a month or so ago, and then we've taken what I would call another leg higher, to look back and reflect on what caused that. And for me, the clearest signal that has come from that has been a continued move into more and more fiscal and central bank stimulus. So the latest round, and I think it started right in the middle of May, was from the central bank, and maybe less from the central bank, but the fiscal side in Europe, when Macron and Merkel came together and said that they were going to issue joint debt to fund especially some of the weaker countries, but give them grants for issues that they're facing from the coronavirus. And then Germany also came out and said that they were going to do their own large fiscal relief package, which was a large turnaround for them because they have been against running any deficits. So you had an economy that wasn't able to issue joint debt sort of come out and announce that they would do so. So that caused a sharp rally in the euro because the euro itself was looking possibly a little fractured at that point. So that put more confidence in the euro currency. And then the fact that, again, it was just more stimulus on the global stage, helping equity prices continue to do a lot better. So I think a large part of what is happening has been, we've had an economic impact, and the metaphor I'm using is we have these stimulus measures that have bridged us to where the markets are now. So I think for me going forward, you really have to look and say, is that bridge big enough, long enough, whatever adjective you want to put on it, to, keep this chasm or this gap between where the real economy is and where equity prices are. And I think that may come under some strain. It's been my view that there's been a bit of a financial holiday, I think, with some of the stresses that have been alleviated on the short term, especially on the consumer side. And we saw that with a very sharp bounce back in consumer spending and the retail sales number that we had in the U.S. earlier this week. However, is that enough to really turn the economy, turn the job picture that still doesn't look very good, turn the manufacturing side of the economy higher? I have my doubts there. So while we are, near highs, I'm still skeptical. I still think this market is expensive. So I'm a shorter term trader. I can use, the last couple of days we've come up and put in a lower high than where we were just last week. So I'm able to use that and say, okay, this is a decent risk reward scenario to look for some downside price movement. If you're not a short-term trader or a shorter-term trader like I am in the futures and options market, then maybe you're looking at, another opportunity to lighten up what has been a tremendous rally off the March lows. And I'm not saying, sell out of all your holdings. Equity prices could go higher. But especially, certain stocks, certain names have performed incredibly well in the last little while. And like I say, I think still carry a significant amount of downside risk if we get any sort of negatives that come into what I think has been a pretty sort of sunshine and rainbows picture, to get prices to where they are right now. And I do think there are some negatives or some worries to look out for as we move forward. And if they come into the investment picture, the investor psychology a little more than they have right now, again, as I said last time, I think the bad news is more likely to be ignored when we're in this bullish phase, but it doesn't go away because it's being ignored. So if we start to realize it, start to pay a little bit more attention to some of those worries, then I think we are at quite lofty levels. So I am currently looking for a little bit of downside. Again, that's on a shorter term time frame than a lot of people might be on. I'm able to sort of meld that with where prices are, those sort of technical aspects that are giving me that early indication. And again, I can be wrong and I can be out and move on fairly quickly and look for another opportunity, or look for more upside if I really do come full circle and believe this is going to continue on. I just don't see it there. I think there's too much of a mismatch in equity prices and the underlying economy right now.
We'll have more with Drew Zimmerman right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, is there a chance we hear so many millennials who used to bet on the sports book have decided, well, I'll go bet on stocks, and so far the stock markets more or less have been going up for them, but are they going to get burned at some point and find out that this isn't the quick, easy way to make money all the time?
Yeah, it's been a very popular topic over the last maybe month, especially in the last couple of weeks. The rise of the Barstool president, live streaming his trading, explaining how easy it is to everybody and that Warren Buffett's an idiot. There's a reason he's doing it. He's a content maker, a content provider. It's working. He's been on CNBC. I mean, not a lot of day traders that start up can say that they've reached that notoriety in the financial markets as quickly as he has. So he's done his job in that sense. Has he, brought in a whole new wave of investors that, haven't been in the stock market before and are maybe thinking under the false pretense of how easy this is, that, the Fed's going to get your back and stocks only go up. I do think it is a story that will likely not end well for a lot of people. If you're chasing these moves, I mean, and we're seeing very high volatility. I mean, to see some of the names that are popular with these day trading accounts, you can see the largest holdings on Robinhood. I mean, these single names are moving, 20, 30% over the course of a couple of days. These are very volatile swings. So, people can make money and lose money very quickly. And in that environment, I think, maybe not a bad environment to learn to trade, but at the same time, I think they're being taught to buy dips, and those dips just get bought up. So if we are going to see a bit of a change in trend from the uptrend that's been in place for the last almost 3 months now, then I think there's some severe risk if they especially add to positions that they bought on the expectation that they will come back up, because there's times when they just don't. And especially if you're using margin, then you're out of the position before you had the chance for it to recover. So I do think there's an incredible amount of risk to the individuals that are getting in. And, I don't want to speak broadly about everybody, but the knowledge of the instruments that they're trading and how they're trading it may be lacking compared to what it should be. I hope that's not the case, that people can make smart, informed decisions. But again, we see a lot of stories where that's not always the case. So I hope it doesn't end in tears like a lot of people are predicting. Unfortunately, that might be the way it has to end. I mean, the market is known to sort of push people through the pain. Trade is always what's going to hurt the most people, and that tends to be the way that the market goes. There's been a lot of people very bearish the market. I've definitely had a bearish tilt over the last month. So, it's been proving me wrong, the fact that it's up at these levels. But, at some point, I do think it will be the new day traders that have to experience that pain trade. And that's where hopefully, they learn a lesson without having to, really sort of cave all in on this trading experience that they've had.
Why is the equity market so important to how you look at the markets right now?
Yeah, I think the equity market these days has really gotten a lot more attention than I would normally give it. I mean, I focus on a lot of different asset classes in the futures markets. So I'm looking at currencies, I'm looking at energies and precious metals and interest rate products, as well as the equity indices. But I think we've become such a, dependent on market psychology that the equity markets are the best barometer. And for me, the S&P is sort of the key market I'm watching. There's some variances in the U.S. equity markets, but the S&P is the big one. And it's become so important because of that market psychology. And I think it is the ultimate indicator of that market psychology, that it is the dog in this market, and the other asset classes tend to be the tail. So again, you can argue that no, the bond market is the biggest, it's the smart money, and it's going to dictate where things go over time. And I do agree with that. And I think you can look to the bond market and you see that interest rates haven't rallied all that much off the recent lows compared to how much equities have rallied. So the bond market might be telling you something else there. The bond market also has, a lot of impact from what's going on with the Fed buying a lot of bonds to generate the stimulus that they are right now. So that can also be having an outsized impact. But the equity market, just to come back to the fact that it is the sentiment indicator of risk on or risk off, and that has been so detrimental in everything else, whether that's trading the Canadian dollar, the Australian dollar, even the euro currency, the Japanese yen, even the energy market. I think if you look back over the last couple of months, and I follow the energy market closely, when you have oil related news, whether that's inventory reports like we had this morning or other reports from OPEC, it's having, less impact on the price than a day where the equity market is, up 80 points or down 80 points. That's going to have a bigger impact on where oil prices go than, the specific news to that market. And that tells me that this market psychology is the driving force in markets right now. And it really does come down to more, are we taking risk today and bidding up the Canadian dollar, bidding up energy, maybe selling some gold, or is it risk off? We're worried about something in the future or near-term future, and therefore, we're worried about the demand of oil, so we're going to sell that. We're worried about, riskier commodities, so we're going to sell the Australian dollar, sell the Canadian dollar. That risk on, risk off sentiment really does come down very clearly over the last couple of months to the barometer that is the stock market in the U.S. So it's very difficult to tell where the equity price is going to go, on any given day. I do think we're at an expensive level at this point. So I think there's a lot of risk in a lot of other markets because they are likely to sell off if we're going to see a sell-off in the U.S. equity market. So it's not easy, but I think it's become a very dominant factor. And I would say it's not necessarily a healthy market if the individual asset class that you're trading is not normally that correlated to the S&P, but in this type of market psychology, we're going closer to what I would call correlations of 1. Doesn't necessarily mean it's a healthy market, but it's how it is right now. So it definitely has focused a lot of my attention more in the equity markets because you almost can't be right in the currency markets. You can't be right in the energy market if you're wrong on what's happening in the equity market. It's become that important.
We'll have more with Drew Zimmerman right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Drew Zimmerman. Drew, what's your view on the oil market now that it has recovered from the low negative prices seen a couple of months ago?
Yeah, as I was just talking before, I think the oil market has been, greatly tied to this equity market, whether it's a risk on, risk off. If the equity market's continuing to do better, I think that means investors are seeing that the reopening is going to continue to go well, which should also increase the demand for jet fuel, for gasoline, which should see oil prices doing better. So we had the initial run up off the lows over the last month and a half, where the front month of oil got up to $40 again. We ran out of steam. We've now run back up to about $39 and are starting to look a little soft again. So as I just mentioned before the break, I do think it's hugely tied to the equity market. I do think oil prices, almost doubling in the last month and a half, are again stretched to the upside. I think it's very, hopeful of where prices can go near term. We are seeing some good improvements for the oil market specifically that I think are going to help oil prices in the medium to longer term. That's, maybe through this winter and into next spring. But again, that's going to depend on, if there's a second wave and where demand levels are for gasoline and especially jet fuel, which has really not recovered because people still aren't flying. But on the supply side, we've seen a huge amount of U.S. supply. I mean, just this week, our inventory data on the weekly level showed a drop of 600,000 barrels a day off of U.S. production. So, we're over 2.5 million barrels off of the recent highs or all-time highs in U.S. production of 13.1 million barrels a day. So it's been a very significant drop-off that we've seen in U.S. production. We continue to see the rig counts, tremendously lower than where they were 3 months ago. So these bad prices have really sowed the seeds for prices to do better going forward. However, near term, I still think, the markets have gotten excited to get prices back up to $40. There's still a tremendous amount of oil and oil products in storage in the United States, a little less so in Cushing, Oklahoma, which is our pricing point and delivery point for the WTI futures contract. And that's helped alleviate the fears of running out of storage of the delivery crude, which has helped the front end prices. But overall, we've still got a tremendous amount of storage, or energy in storage. Commercials are using the Strategic Petroleum Reserve that the U.S. has, to lease out and store more oil. We're adding, several million barrels to that each and every week, just again, to have more storage space. So the energy picture near term, I still think is going to be under some stress, under some pressure. And as much as I don't like it, a lot of that I think is going to be tied to the overall investor psychology and where equity prices go from here. So given that I think this is, nearing some exhaustion and likely in need of a pullback in prices, I think oil will do the same. So just like equities had a higher high, fell off, have rallied back. Crude oil was up at $40, dropped to 34.5, has rallied back to 39. I think we can head lower from this 39 level, and again on a shorter term time frame, able to use this opportunity, this lower high, which is a great chart pattern if you're looking to get short of a market, to get into a short position and look for prices to go lower.
What's your view on the Canadian dollar?
Yeah, the Canadian dollar has been, again, tied to the risk on, risk off currency. But I do think that we have to look at the fundamentals in Canada as well. So we're going to see our retail sales number this Friday. That's going to give us a bit of a glimpse into the consumer. Now, the problem is we just saw the huge retail sales number in the U.S. at the start of this week. That was for May. So we're going to see the number for the month before that in Canada. So it's going to be a very ugly number. I think that's going to have some negative consequences for the currency. I think the Canadian economy was in a worse spot than the U.S. economy was when we were coming into COVID. But again, we've been buoyed a lot by both central bank action and fiscal action. Trudeau, again, just extending the CERB policy by another 8 weeks. So Canadian individuals hopefully aren't under too much stress. Again, I think this helps sort of lengthen that bridge between where the real economy is and where some of the financial economy is at. But again, with oil prices headed lower, if we're near a bit of a high or at high levels on the equity markets, then I think Canada does have some downside risk to here. We had a strong run up off the lows from 68 cents all the way to 75 cents. We backed off. We sort of bounced back towards 74 cents. And again, I mean, it's a very familiar pattern because as I mentioned earlier, a lot of markets following the ebbs and flows, the risk on, risk off of the equity markets, but the Canadian dollar rallying back to what looks like a lower high. So if we start to roll over from these prices, I think there's a significant downside where, no, we don't necessarily have to test the lows that we were at, but I think Canada could easily move back towards the 70-cent level, which is a fairly large move given the history of how far the Canadian dollar moves. So I think there's risk because of the energy prices. I think there's risk just because of general market or equity risk. And I think that will continue to be an impact on Canada. And again, I think Canada is more or less of a consumer nation like the U.S. is. They're more self-fulfilling, where Canada is more of an export-driven nation. And especially in an environment of lower global trade, I think Canada's economy is going to continue to struggle a little bit further and longer than the U.S. economy. So overall, short-term and medium-term, I definitely see some weakness ahead for the Canadian dollar.
Drew, thank you so much for being on the show.
Thanks for having me on today, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. Check out his websites, pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.